Okay, FCFF method, and here we are talking about how to estimate a growth rate of EBIT going into the future. Okay, it's just one way of doing it, estimating growth rate, which means there could be other ways of doing it, but we are talking about more fundamental way of doing it, which is the multiplication of reinvestment rate and ROC. Fundamentally, you grow based on what you reinvest and how much return that you generate out of those reinvestment. There is no free lunch. Okay, there is no free lunch. That's fundamental ways, right? Okay, so we already had two encounters about this growth rate. Same idea applies to estimating EBIT growth rate instead of net income. You just need EBIT times 1 minus tax rate instead of ROE. You just need ROC. And then ROC, is that the same as ROIC? Yes, invested capital or capital, it doesn't matter, okay? Just a name issue, okay? The concept, the definition itself is EBIT times 1 minus marginal tax rate divided by 1 minus the invested capital, okay? Which is book value of debt plus book value of equity. But remember, book value of debt is only the financing part. Forget about notes. Forget about accounts payable and the deferred tax liabilities kind of things. Okay, now expected EBIT growth rate. Well, just like ROE, ROC is closely related to the competence of the management, the CEO. Okay, it is a key performance metric of management, and this is why you need to look at the track record of the CEO in terms of historical ROC and ROE. Okay, and this is the reason why DCF valuation works best for the companies with long track record. Okay, it enables you to predict what's going to happen given that the same CEO is there, or the CEO's track record is available, or the company's track record is available. Okay, and then in case you assume a significant restructuring with new business strategy with replacing the existing CEO, you need to impose or assume some new ROC or ROE associated with the new management team. Okay, now ROC of Samsung Electronics and SK Hynix and Hyundai Motors, right? It's not Hyundai AI, okay? Motors, HMC. So I give you track record of these guys in the ROC, right? You see Samsung Electronics and then these three companies. Overall, semiconductor is much more volatile industry than car manufacturing, even in terms of ROC. Okay, HMC is just a stable, very dull rather, whereas SK Hynix, right? Very exciting, moving like this. Okay, within semiconductor industry, Hynix has been much more volatile, spiky than SEC, Samsung Electronics. You know the reason, right? Samsung has diversified divisions. Okay, and then ROE. Okay. In the same perspective or same scale, okay, I show you ROE over here for the same three companies, and you realize, oh, ROE is much more volatile, even for the same company, right? Why is that the case? Because of what? Leverage. Okay, leverage. The ROE is about the equity holder's perspective, so that the impact of leverage is come down to the ROE, and which makes it much more volatile. By borrowing from the bank or the creditors, the shareholders suffer from the chance of bankruptcy, and you still have to pay interest regardless of the industry cycle or business cycle, which makes the return on equity holders much more risky, volatile. That's the intuition. So let's mathematically try to dissect this guy. So small I, well, we define the interest expense on your income statement divided by book value of debt. Again, the debt has to be the funded debt only. Forget about deferred tax liabilities and then accounts payable, right? Remember that. T should be your tax rate. And then ROE, Well, you can it is defined as ROC plus book value of debt over book value of equity times ROC minus interest I times 1 minus tax rate, because this interest expense is tax deductible, right? And then if you do the math, and then you will realize it should be ROC times 1 plus book value of debt over book value of equity minus book value of debt over book value of equity times after-tax interest expense. Okay, that's what's going on over here, and that is your ROE. Okay, and then now we talked about the a way of estimating growth rate in operating income or income as a whole generally. The third, okay, is the fundamental method, and we tackle this issue first because it is strongly based on economic fundamentals. Your growth comes from whatever you reinvest and the return that you generate from those reinvestments. Multiply these two, and then you will get the growth rate projection. Okay, but there are other ways of estimating growth. Okay, it's your liberty. Okay, it gives you liberty. One way of estimating the growth rate is just look at the past. Okay, the historical growth in earnings per share is usually a good starting point for growth estimation and gives you an idea about how the management has been doing. But what about the life cycle of the firm? Okay, historical, right? Well, maybe your company used to be a small growth company, but not anymore. And you are in a mature company for some reason that you just don't know. Maybe this industry is saturated and things like that. Then the historical data may be useless. Okay, you have to be more adaptable. Okay, in adopting this kind of method or not. Okay, you have to be. It's your discretion. Okay, whether you choose historical method or not. Number two method of estimating growth, look at what others are estimating. Okay, analysts estimate growth in earnings per share for many firms. It is useful to know what their estimates are. But here in this method, are you sure that these analysts are not biased? Okay, are they just herding? Okay, it is well known that the analysts in the market, they herd because of their career concerns, right? You just follow the majority, and then you will be just performing average, and you will not be laid off. Okay, so they have their own incentive to herd, and then the group of analysts, right? They suffer from biases with the sentiment in the market. Then you will be in trouble using this second method. So that's why in textbook approach, right, we teach you to use this fundamental approach. Be on your own. Okay, growth rate, no free lunch, right? Whatever the company reinvest, and then the return that the company generates from those reinvestment should be the primary source of growth. So multiply those two, reinvestment rate and ROC. That's going to be your growth rate of after-tax operating income. So that's the third approach. Okay. And then reinvestment rate, right, should be nothing but net capital expenditure plus change in non-cash working capital divided by after-tax operating income. Okay, and then another way, okay, the same thing is that times ROC, right? What is it? The growth rate of EBIT should be net capex plus change in non-cash working capital divided by after-tax operating income. That's reinvestment rate times ROC. Okay, so that's the fundamental idea. Estimating growth in EBIT, Cisco versus Motorola as just numerical example. In 1999, Cisco's fundamentals, well, reinvestment rate was 106 or 7%, and then return on capital was 34%, and then what was, if you assume this kind of reinvestment rate and return on capital will sustain going into the future, what should be their expected growth rate in EBIT? Well, multiply these two, which is 36%. Very high growth rate, right? You can see that Cisco was, giving, how do you say, the analysts were, had every reason to be more optimistic about Cisco, given their reinvestment rate and ROC being very, very high. And then the valuation of Cisco in 2000 and 1999, it was very, very high because the analysts were anticipating with these fundamental relations, and then they were assuming high growth rate. What about Motorola? It was more like a existing company, brick and mortar kind of. And the reinvestment rate was a lot lower, half of it, 53%, and ROC was also less than half of it, the Cisco, 12%. So the analyst expectation about the growth rate of this company turned out to be about 6%, if given that they were basing their judgment on these fundamentals, right? ROC and then the reinvestment rate based on their history. So the valuation was much lower. Anyway, and as we see this ROC and ROE kind of ratios, I should pay more. I should draw your attention to something called the Dupont Analysis and its variations, because Dupont Analysis is FAQ, frequently asked questions in your job interviews anyway, and then financial analysts play with this thing very often, right? Very often. So ROE is defined as net income divided by book value of equity. But remember, the book value of equity should be beginning balance or last year end, okay? And then net income is what you generated over current period. Then here comes mathematician's favorite technique, okay? How? Well, you split the numerator and denominator, okay? And then multiply and divide by the same number. But not just once, but twice. So multiply and divide it by sales of the current period, and then multiply and divide by assets at the beginning of the period. Why beginning of the period? Because just, to be consistent with your book value of equity over there, okay? And the final destination will be your leverage ratio, book value of debt over book value of equity. Why do we do this kind of mathematical manipulation called Dupont analysis? By doing this, we can tease out some important economic intuition, analyzing your ROE, okay? Remember, ROE and ROC, the return on your investment, either from your equity side or from both debt and equity side, right, is such an important fundamental variable, okay? Then we want to find out what is driving your return, ROE or ROC. We're starting from ROE, right? If your company experience shows you a high ROE, where does that come from, okay? Where does that come from? You don't want to just simply say to your boss or your clients, this company has been generating high ROE, so trust this one and go ahead and buy it. No, they or you have to be more interested about the source of this return. How can they generate, okay? Is it sustainable? The high ROE or high ROC, where does it come from? So Dupont analysis gives you a better idea about where does this come from. As it turns out, the first element in your Dupont analysis is net margin, okay? For the same sales amount, you sell the same phone, and then for each dollar of sales, how much net income does this generate, okay? Well, Apple, I show you over here, generates high net margin because they have strong brand equity. You enjoy marketing and learn about brand equity, and this is where your brand equity pays off. If your company does not have strong brand equity, you cannot charge higher price. Your margin will be thin. In that case, your net margin will be smaller and then more likely your ROE will be poor. Apple versus Samsung in terms of cell phone. That's what's happening there. The next item is called asset turnover. Okay, for each dollar of assets, okay, how much sales do you generate? Okay, so factory or equipment, okay, for the same amount of assets, how much sales can you generate? It tells a lot about the efficiency of your management. How diligently do you work for a given dollar of assets that you have? It could be fixed assets, it could be human capital, right? For the same number of employees, how much sales do you generate? If your company is JYP kind of entertainment companies, for the same number of singers and dancers, how much sales, ticket sales do you generate? Okay, that shows up in your asset turnover. Okay, and this is perhaps the most important figure measure. Okay, telling you about the sustainability of your strong business. Okay, this is what fund managers care most about. Okay, how about this one, the brand equity thing? Isn't it good? Isn't it important? They are important, but remember, okay, brand equity is not for every company. Okay, it matters if it is luxury goods kind of industries, cosmetics, or a cell phone or consumer related things, but for majority of the companies in the world, they are more like B2B, where the brand equity may not be that much of a matter. For most of the majority of the companies, what matters is about the asset turnover. Okay, efficiency. How diligently do you work? Okay, for a given dollar of asset that you got, right? Asset turnover. If it is high, it is more sustainable. Very, very important. Okay, and then what about this 1+ leverage ratio, book value of debt over equity? Well, this tells us an interesting story. There are 3 different ways of achieving high ROE. One is high margin, another is high asset turnover, and the other is high leverage ratio. That means high ROE coming from high leverage ratio, you have to question it. Okay? Superficially, the management can cosmetically they try to show high ROE, artificially high ROE, by leveraging up, even though they have poor asset turnover and poor net margin. If that is the case, the future of the company may be dismal. Okay, the high ROE, historical high ROE, may not be sustainable. Okay, so what does this tell you? Look at the historical ROEs and then look at the historical elements of this Dupont analysis. And that's why I gave you the homework number 5. And I tell you, okay, look at the cosmetic industries ROE graph, time series graph, and then where does this Estee Lauder go? Okay, by looking at ROE and then each different element. Is it coming from their leverage or operating, the efficiency or brand equity? Okay, you can tease out those stories based on those numbers. Okay, look at the graph, and you could modify the formula in your own way. Just multiply and divide by the same number. Instead of assets, you can replace it with IC, invested capital. That's also just something you can do it, but the idea will be similar anyway. Instead of assets, you're just talking about in terms of investors as a whole, and then you could apply the same idea of Dupont analysis decomposition on ROC. So ROC, you start with after-tax operating income divided by invested capital. will multiply and divide by the same sales amount, right? And then the first item will be NOPAT margin. The second item will be invested capital turnover, okay? So this one will give you the same idea as the margin, okay? Brand equity, you will have higher NOPAT margin, either net margin or NOPAT margin, right? You see that. And then the second item will be about the turnover, okay? But in this decomposition, you will not have leverage ratio because it's not about just equity side, but about the whole return, total return to the both investors as a whole. So the leverage, we don't care about it over here, okay? So that's one thing to notice, by the way. And then the next item, that's the set of slides, we're going to talk about the Hyundai Motors, just a numerical example. So wait for the next video. Thanks for watching.